Welcome to Talk Tickers. We cut straight to the heart of earnings calls to give experienced investors like you the critical information you need, fast.
Exactly. No noise, just the signals.
Today, we're diving into a recent earnings call. We'll kick off with the headline numbers.
I'm good.
And then we'll really dig into what's driving the performance and, the outlook.
Okay, right off the bat, the year-on-year figures, they show some pretty impressive momentum.
Yeah.
Recurring net income surged by over 39%.
Wow, 39%.
And that's with a healthy 8.6% increase just quarter over quarter, landed just shy of $5.9 billion.
Okay, strong numbers. And ROE.
That strength flowed through to a solid 14.4% return on equity.
Okay, and the revenue picture. Must be looking pretty robust, too.
It is. Hit $32 billion. That's a 15% jump compared to the same time last year.
15%. And digging into the components a bit, net interest income.
NII saw a substantial 13.7% year-on-year climb.
Okay.
With a more, let's say, modest 1.4% uptick from the previous quarter.
Right. And fees.
Fee and commission income also contributed nicely. That grew by about 10.2%.
Solid.
But I think the real standout in this initial snapshot has to be the insurance segment.
Ah, yes. How did that do?
Just remarkable year-on-year growth, 32.7%.
32.7. Okay, that is a standout. So those are the high-level numbers.
The big picture, yeah.
Now, let's really unpack what's fueling this. The call spent quite a bit of time on their loan portfolio, right?
They did. It's now expanded to a significant $1 trillion.
$1 trillion. And the growth rate there?
That's up 4.9% year-on-year and 2.4% quarter-on-quarter.
Okay. But there was an interesting point about an acquisition, wasn't there? John Deere Bank.
Yes, exactly. And this is key if you exclude the impact of acquiring John Deere Bank.
Then what happens?
The underlying growth actually jumps to a notable 11%.
11%. Okay, that distinction is really crucial then for understanding the sort of organic trajectory.
Absolutely. And looking at where that growth is concentrated, loans to individuals saw a pretty significant 16.2% year-on-year increase.
16%. Strong.
But maybe the most aggressive push seems to be in lending to micro, small, and medium-sized enterprises, MSMEs.
Oh, yeah. How much growth there?
That segment grew by nearly 30% year-on-year.
Almost 30%. Wow. And what's driving that specifically?
Well, they mentioned it's mostly driven by working capital loans. And importantly, these are fully collateralized by receivables and also backed by government FGO, FGI guarantees.
Ah, so the guarantees reduce the lender's risk. Sounds like a calculated move, into a high growth area, but mitigating the risk.
Precisely. That seems to be the theme, emphasis on security. The rural sector also showed strong growth, again in collateralized real estate financing, with low loan-to-value ratios.
Makes sense. What about wholesale banking?
A bit more muted there. Growth was about 1.2%. They put that down to the sort of ebb and flow of capital market activity.
Right, volatility.
Yeah, though they did highlight continued progress in areas like bond issuances and secondary market stuff.
It's interesting, isn't it, how they're focusing on bolstering credit quality alongside this growth?
Very much so. Prioritizing collateralized loans, maintaining a, let's say, cautious risk appetite for the year ahead.
And they're putting resources behind it.
Seems like it. They've apparently increased headcount and are using machine learning quite intensively to refine their credit models and policies.
That suggests a proactive approach, right? Trying to manage potential downsides before they hit.
Definitely. That investment in their risk management framework, it's a key indicator, I think, for long-term sustainability, especially, the current economic climate.
Good point. Did they mention payroll deductible loans? That's usually a focus area.
They did. Highlighted their leading position there among private banks, holding a 14.3% market share.
14.3.
And they see this as a significant avenue for more personal loan growth.
And expanding in other secured areas too, I gather.
Yeah, things like FGTS guaranteed credit cards, apparently gaining traction in higher income brackets.
Okay.
And also notable growth in CDC. That's basically a type of secured credit line and in financing international trade.
So strategically targeting growth, but in segments with that built-in security.
That's the clear message. Now, shifting gears maybe to net interest income.
Yeah, NII. That was up almost 14% year on year. Big driver.
Huge driver. And they attribute this to, well, two things mainly. The asset portfolio growth we just discussed, coupled with a stable cost of risk.
Okay. And within NII, there's the market side and the client side. How did the market NII do?
Performed strongly, actually, driven by their ALM strategies, asset liability management.
Right, managing assets and liabilities to optimize returns while controlling risk.
Exactly. It allowed them to sort of capitalize on market volatility, plus positive contributions from trading activities, too.
And the client NII, that's the core lending business margin, right?
Yeah, and what's particularly encouraging there is the consistent growth, up 15.5% year on year.
Steady progress each quarter.
Seems so. And underpinned by the quality of the loan book. In fact, get this, client NII, after accounting for provisions for potential losses,
Net provision.
grew by an impressive 36% year on year.
36%. Okay, that really highlights the quality aspect.
It does, and it seems that focus on prudent lending is reflected in delinquency rates, too.
How so?
While over 90-day delinquency is reportedly well managed, a significant chunk of their portfolio is in the earlier risk stages 1 and 2.
Okay, less worrying stages.
Right. And even for stage 3 loans, the more problematic ones, a notable percentage are apparently still up to date on payments.
Interesting. So the collateral is key here again.
Absolutely. It represents a substantial portion of the total loan book and an even larger share of new loan originations. It's a significant buffer.
Got it. Let's move on to fee and commission income then. What was the story there?
Broad growth across most areas, really, driven by just strong overall activity levels.
Any specific standout?
Card income, especially from middle and high income customers, performed particularly well.
Okay.
Also saw consistent growth in their consortium business, asset management, capital markets.
Standard stuff growing well?
Yeah, but the real standout here, I think, was investment banking.
B. How significant was the growth?
Significant is the word. 76% year-over-year growth.
76%. What fueled that?
A robust deal pipeline, apparently, and really leveraging those wholesale banking relationships for both fixed income and M&A activity.
Okay, so definitely benefiting from having diverse revenue streams. Now let's talk costs. Operating expenses were up year on year.
They were up 12% year on year, but interestingly, they actually decreased by 6% compared to the previous quarter.
Down 6% quarter on quarter. What's behind that drop?
That sequential decrease is likely tied to optimizing their branch network. They mentioned closing a significant number of branches, nearly 1,400.
1,400 branches closed. Wow. That kind of rationalization, yeah, that can lead to real cost savings over time.
Definitely. And even with the annual increase in OPEX, they pointed out that growth in personnel and admin costs is actually below inflation.
Suggesting pretty effective cost control then.
Seems like it. They also mentioned ongoing transformation efforts at related companies are contributing revenue and results too.
And are they still investing, despite the cost focus?
Oh, yes. Making strategic investments in key areas, technology, the credit business unit, CRM systems, data analytics across all customer segments.
So spending to save or spending to grow down the line.
Exactly. Investments aimed at improving efficiency and driving future growth.
Okay, let's circle back to that standout performer, the insurance group. You said huge growth, but what about profitability?
Really strong there, too. Delivered a high return on average equity, 22.4%.
22.4 ROAE. Impressive. And the year-on-year profit growth?
Substantial, 25.3%.
Okay. How are they achieving that? Revenue must be strong.
It is. Reached $30 billion in revenue from premiums, pension contributions, capitalization bonds.
$30 billion. And the drivers behind this performance?
They put it down to good management, a healthy combined ratio that's a key profitability measure in insurance.
Right, underwriting profit.
And strong sales capabilities, both internal teams and external partners. Plus, their technical reserves are growing steadily, indicating a solid financial base.
Makes sense. Okay, turning to financial strength, capital ratios, any updates there?
The call indicated their Basel capital ratio has actually increased, so getting stronger.
Good sign. And looking ahead, guidance for 2025. How are they tracking?
Well, they're currently meeting or exceeding their initial guidance in Q1.
So potentially on track to outperform.
They sounded optimistic about potentially outperforming, yes, but they did add a note of caution. Pointed out that economists are anticipating slower growth in the second half of the year.
Okay. So that could lead to maybe a guidance review later on.
Potentially, yeah. They hinted they might reassess outlook later this year.
So the overall message is sort of steady, consistent growth, step by step.
That's the feeling. Achieved incrementally through ongoing investment. They did caution, though, that NII margins might feel some pressure.
Because of interest rates peaking.
Exactly. With the benchmark rate, the SLIC, at its current peak.
Still, the overall outlook sounded positive.
Generally positive, yes. underpinned by those opportunities they see in individual loans, payroll deductible loans, secured corporate lending.
Right, the core growth areas.
And they also expect continued growth in service and commission income driven by payments, those related businesses like consortiums, and that strong ID pipeline we talked about.
So, summing up their confidence for 2025.
It seems rooted in a few key things.
Right.
A low risk, well-collateralized loan book, healthy credit lines, better lending margins, and of course that robust insurance performance.
Got it. The call also touched on specific strategic moves, didn't it? Something for high net worth clients.
Yes, they launched a dedicated service called Bradesco Prncipal, aimed right at high net worth individuals.
How's that going?
Apparently, significant success attracting new clients already. They've got plans to open new dedicated offices, too.
Expanding their reach. And for other business segments.
Expanded service models for the middle market and larger corporations, too, using various platforms to, cater to different needs.
And a big emphasis on productivity in tech. I think I picked that up.
Huge emphasis. They reported significant improvements in, service delivery times.
Faster turnaround.
Yeah, and an increase in the hours their teams can actually spend on business development, not just admin.
That's key. Any specific tech mentions?
They specifically highlighted intensive use of generative AI, Gen AI, including a co-pilot system.
Really? How's that helping?
Improving developer efficiency, apparently, and also boosting customer service capabilities.
Interesting application. We also heard about some internal moves. Legal department?
Yeah, some promotions within legal and a new executive director hire signals a commitment to strengthening legal support across the board.
So the overarching goal remains net income growth.
Based on growing revenue, controlling expenses carefully.
With a non-negotiable focus on asset quality.
Absolutely. And accelerating that transformation plan they've been talking about.
Okay, that covers the main presentation. The analyst Q&A usually brings out some extra detail. What were the key themes there?
A big focus was on improving ROE in mass retail. How? By optimizing the cost to serve and boosting productivity.
Makes sense. Often a lower margin segment. What about payroll deductible loans again? Private sector ones.
Their strategy there is apparently shifting to be more aggressive. They expect growth to pick up in the coming months.
Okay, one to watch. And the insurance sustainability. Were analysts questioning that high growth?
They were. Management attributed the strong performance and lower claims rate to consistent production and, importantly, years of strategic investment, especially in health insurance.
So not just a one-off quarter.
That was the message. They also expressed confidence in loan growth despite macro headwinds, again emphasizing secured lending and leveraging their huge customer base.
Opportunities still seen in public and private payroll loans and specific sectors like agriculture with collateral.
Exactly. Those remain key focus areas.
There was also some clarification on NPL reporting, non-performing loans.
Yes, due to regulatory updates. The focus is shifting more towards stage 3 assets, but they stress they're maintaining adequate coverage, adequate reserves.
Okay. And market NII outlook. Any more detail?
They expect maybe a tighter second quarter. Q2 might be a bit tougher.
Okay.
But still confident in the full year guidance because of their treasury management and ALM strategies. They also hinted at a potential downward adjustment in the implicit income tax rate within the guidance.
Interesting nuance.
Yeah.
What about the drivers for the strong Q1 overall? Any summary?
They pointed to a few things. Better penetration in their existing customer base, that quality-focused loan growth, successful commercial initiatives hitting the mark, and those productivity gains from tech we mentioned.
And they're comfortable with their capital levels to support growth.
Yes, expressed comfort. Said it aligns with their multi-year plan and their historical approach to dividends.
Okay, now there was a significant point about consolidating retail brands, wasn't there? Classic. Next, Dio.
Yes, a big strategic move. The plan is to unify them under a new single value proposition for the mass retail segment.
What's the aim?
To improve efficiency, that cost to serve again, and overall profitability through digital transformation and a streamlined branch network.
When would we see the impact of that?
They expect a noticeable impact on their efficiency ratio starting in 2026, so a bit further out.
Okay, longer term play. What about margins? NIM and loan spreads. Outlook positive.
Outlook is positive, yes. Driven by funding efficiencies, growth in higher margin segments like SMEs, and just the current tighter monetary environment helping spreads.
Right. They also talked about low credit costs in the corporate sector. Why is that?
Attributed it to funds moving into fixed income and just high liquidity among large corporations right now. They don't need to borrow as much or have easy access to funds.
But that might change.
The expectation is it could change later in 2025 or into 2026, especially if interest rates start coming down.
Got it. And back to health insurance one more time. The drivers for that really strong performance, lower claim rate.
Lower claim rate was key, yeah. They put it down to those long-term investments paying off and a more normalized trend after the COVID disruptions.
Makes sense. And strategic things like building new hospitals.
Expected to contribute more in the mid to long term, not an immediate impact, but part of the strategy.
And retail funding. How are they managing that side?
Strategy focuses on managing liquidity carefully, increasing principality, getting more customers, see them as their main bank.
Across all income levels.
Across all levels, yeah. And optimizing the rates they pay on deposits, all leading to a lower cost of funding overall.
Okay. And finally, client NII growth, still conservative.
Approach remains conservative. Focus on secured loans, leveraging their network in payroll loans and SMEs, not chasing riskier lines.
And the John Deere acquisition, just confirming its role.
Viewed as strategically important for agribusiness long term, but the financial contribution right now is pretty immaterial, not moving the needle yet.
Okay, that covers a lot of ground from the call and Q&A. Let's move to our This Is Not Financial Advice segment. Any wild ideas based on all this?
Well, given that repeated emphasis on secured lending, especially collateralized loans, and the tech investment, maybe think about companies providing the picks and shovels.
How so?
Like companies specializing in advanced digital identity verification or fraud detection tech for banks. They could really benefit from this focus on security.
Okay, capitalizing on the security push. Any other angles?
Maybe pair that with a short on companies heavily reliant on unsecured consumer credit, especially those focused on lower income segments who might feel the pinch more in this environment.
Interesting pair trade idea. Hedging the risk while playing the trend.
Yeah, sort of. And another thought, maybe more speculative, linked to that AI push they mentioned.
The Gen AI and developer productivity.
Right. Maybe look into really small early stage VC funds that are only focused on AI and machine learning tech specifically built for financial services.
A longer term, higher risk bet on that specific tech trend within finance.
Exactly. Capitalizes on that strategic direction they highlighted. Again, purely speculative thoughts here.
Absolutely. This is not financial advice. Okay, that wraps up our deep dive into this earnings call.
We've tried to pull out the most critical insights for you.
Hope it's provided some valuable context, maybe some food for thought. What stood out to you listening in? Anything you'll be watching closely next quarter?
Remember, as always, this analysis is just for informational purposes. It's definitely not financial advice.
Please do your own research. Join us next time on Talk Tickers for another deep dive into the world of finance.